This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
So what is the auditor's responsibility towards fraud and error in the financial statements? Well, fraud is deliberate stealing of cash, assets, or indeed overstating profits. Error is accidental. I suppose at the end of the day, they're kind of the same financial effect. What, first of all, is the auditor's responsibility with regard to fraud? And the first thing we can say is there are, in a way, two levels of fraud. There is fraudulent financial reporting. This is where maybe to boost the share price, or maybe to encourage investors in a company, or to encourage the bank to give a loan, maybe you overstate the profit of the company, you make it look a much healthier, less risky company than it really is. And this is what induces the investors in the bank to provide you with capital. Or you report inflated profits in the hope that the share price will be driven up, so you can then sell the shares. Or you cover up losses in some way in the hope that, we've made huge losses this year. We don't want to tell anyone about that, otherwise it'll lose confidence, so we'll cover up those losses in the hope that in the subsequent years will come good. So that can do huge damage to investors, banks, financial institutions, members. The other type of fraud is the misappropriation of assets from the company, the theft of inventory, the misappropriation of cash. It can be awarding contracts at a very high price so that the buyer gets, a 20% kind of kickback, a commission. This is essentially stealing money from the company. So we have these two levels of fraud, and both are potentially serious. The biggest question really is, what is the auditor's responsibility towards discovering fraud? Or indeed preventing fraud? And the simple answer is relatively little. It is management's responsibility to ensure that there's a proper system of internal control which should be sufficiently good to prevent or detect fraud. The auditors have no specific duty to detect fraud, and indeed many frauds are relatively small, repeated very often, and the chance of an auditor maybe picking up small fraudulent transactions is really quite small, probably not a good use of their time, in fact. But when the fraud gets large, and it becomes so large that it's going to cause a material misstatement in the financial statements, then like any material misstatement caused for any reason, whether innocently or fraudulently, then the auditors should have spotted that. They say in the audit report that it gives reasonable assurance that the financial statements are free of material misstatements. Okay, it's not a guarantee, but no one is really very happy if material misstatements get into the published financial statements. So no routine ongoing need to discover fraud, but you should be aware that it can happen. As part of the planning, you should be aware that some companies are going to be more susceptible to fraud than others simply because of maybe the sort of operations they're in. You should be aware that the internal controls are very poor. Then this opens the door very often to fraud, because maybe you don't have segregation of duties, you don't have proper authorizations, and so on. Once a fraud is discovered, it has to be reported to management. The big question, of course, is if you discover a fraud, let's say of $20, is this just an isolated fraud carried out once by one person, or is it really the tip of the iceberg? How long has it been going on? How much money over the course of the fraud has been sucked out of the company? How many people are involved? We need to get to that. In a way, our suspicions have been alerted. Once small fraud is discovered, we can't kind of pretend we didn't see it. We must act with integrity and follow it up. With regard to errors in general, or misstatements identified, all misstatements, even very small ones, should be reported to management. It would be peculiar if you discovered even a small error, maybe of $25, and just kind of kept quiet about it. Why not show this to management? Management may decide not to bother correcting it. And there's a certain element of embarrassment here, of course. The accounting people have prepared the financial statements. Presumably the finance director has kind of approved those financial statements. And here the auditor comes in and finds lots of little errors. It's kind of a little bit embarrassing if the finance director has to maybe go back to the board and say, well, the profit has been adjusted because of these small errors. We don't really care, auditors don't really care about immaterial errors. It's not their purpose to certify 100% accuracy. We're looking for material misstatements. You should be asking management to correct them all. I mean, that's really the proper thing to do. But if management doesn't correct them, then you have to think, well, how material is that error? And make your own mind up, but also get written representations from management that they themselves think that the uncorrected errors are not material, and that presumably you would agree with those. If there is a material misstatement, an error, and you think it is material and it should be changed, then really, if they don't change it, you're going to be heading towards some sort of qualification of the financial statements. You are saying these financial statements contain an amount which is materially incorrect. So you'll be going down and saying, except for the fact that receivables have been overstated, the financial statements show a true and fair view. Or you might say, because of the receivable has been overstated by 5 million and the effect on the profit would be to turn a profit of 3 million into a loss of 2 million, we think that the financial statements do not show a true and fair view. You'd be looking at an adverse opinion.